Federal Reserve is going to allow all of the financial markets simply just to fall and just keep falling. The United States economy has become more interest rate sensitive than at any other time in its history. The amount of debt that was taken on by corporations, by consumers, and of course by governments is absolutely astonishing. And so to begin raising interest rates in this environment is not just a normal walk in the park.
You mentioned in a recent podcast that when it comes to the stock market, as January goes, so goes the rest of the year. So as we're seeing, a lot of the stock market indices making all-time highs, what does that signal for the stock market for the rest of 2022?
It's really interesting. So the name of that podcast episode was called the January Barometer. And that's actually a phrase that was adopted by Yale Hirsch, who is a well-known, well-respected stock market analyst who's passed. Jeffrey Hirsch has taken over Yale Hirsch's research, his son, and they put out the Stock Traders Almanac. So many people are probably familiar with that name, maybe not the Yale Hirsch name, but or Jeffrey Hirsch, but the Stock Traders Almanac, just a wealth of information. And I've used it for years. But on the latest podcast episode, I wanted to remind listeners of the very interesting correlation between how January goes and how the stock market goes overall. Now, it's not bulletproof. Sometimes it fails. But, since 1950, the so-called January barometer has been right about 84% of the time. So that what that means is that if the month of January is up, then typically that bodes well for the rest of the year. There's also something called the January trifecta, which is not just the barometer, which measures the whole month and says, how is that going? But also it looks at the first 5 days and says, how did those do? And if those do well, that also can be indicative of the rest of the year. And then there's also the Santa Claus rally, which is kind of completes the January trifecta. And so anyway, we really just spent some time kind of talking and breaking that apart to help people see. So right now, the market, of course, has been under pressure in the month of January. So the first 5 days weren't that hot. And the month of January remains to be seen because we're still just, a third of the way through. But when the month is over, it'll be interesting to see, how that, January barometer works. But right now, I would suspect, and this is early, and I have no crystal ball, but it's hard to imagine that the Fed, the Federal Reserve, is going to allow all of the financial markets simply just to fall and just keep falling. The market is simply repricing risk. It's beginning to price in potentially 3, maybe 4 rate hikes. It's difficult to imagine that the Fed does that. That's what I'm saying, Elijah. It's difficult to imagine that the Fed is going to do what it says it's going to do this year. So anyway, that's probably a whole nother question, but that's what the January barometer is. And they can listen to the latest podcast episode, followthemoney.com. Check it out. It's really quite interesting.
The Fed is saying that they're tapering twice as much as usual, and they're going to end their quantitative easing program early. Also, those 3 rate hikes that they're considering this year. Why are you skeptical that that will actually happen? And what would it mean for the stock market if that does happen or if it doesn't?
So just to back up slightly, some banks have been calling for at least 4 rate hikes. And I believe JP Morgan or Goldman Sachs, one of the two, is forecasting that we'll see 4 rate hikes, not just 3. The Fed has telegraphed 3. Okay, so we are currently in a near zero interest rate policy, right? I mean, we've been near zero for a long time. And when you look at the average interest rate over time, if you go back for the last, say, 3 or 4 decades, you'll find that the median interest rate was this is the Fed funds rate, was 5.67%. 5.67% is the average rate for the last 3 or 4 decades. Now, what's ironic is for so long, Elijah, we've heard about how great the economy is, right? This is the greatest economy ever. I mean, we heard that, a lot of the chest beating. Oh, that was the greatest economy ever with 0% interest rates. It makes you wonder how strong the economy is if you raise the interest rate, let's say to 5%. How about we just go back to the average or the median interest rate of 5.67%? Would we still have the greatest economy ever if we had just average interest rates? And the answer is no. In fact, where we are right now, I would suggest is that the Fed, after analyzing this stuff for more than 2 decades now, I would suggest that the band that the Federal Reserve is working within as far as the interest rates is that they have anywhere, say, -1% all the way up to about 2.5%, maybe 3% if they just want to spook the markets and then bring it back down. So the band that they have to work with is very, very small. So what I'm saying is that the Federal Reserve, it only has a couple of buttons that it can push. One button is to make money easier. The other button is to make money less easy, right? So that is raise interest rates, lower interest rates. That involves printing money and all of this. Now, the Federal Reserve is kind of desperate in the fact that it's pushed the button that has lowered interest rates, and it's created all of this massive, widespread inflation, in addition to other problems as well, not just the Fed. And the Fed now is caught in a problem because if there's another issue that pops up, what can the Fed do? Can they lower interest rates again? No, they can't lower interest rates any more than they are. They could stop tapering and they could start buying more. I mean, that's all they can really do. So the Fed, what it always does, and anybody who's been investing or trading for any length of time, and you've been watching the Fed, you know this, they vacillate between, pushing this button and that button, boom, bust, boom, bust. So what they're doing is they're trying to get enough ammunition in their gun by raising rates and getting less easy money policies out there so that they can do it all over again. Because inevitably in this kind of boom bust economy that we're in, which is largely driven by the Fed is going to need that ammunition, and they don't have it right now. So we're sailing into, what could be an uncertain year, and the Fed has very little leverage. So the Fed needs leverage, and they're going to raise rates, so they have that leverage. Now, the reason why I question whether they're going to raise interest rates is because the United States economy has become more interest rate sensitive than at any other time in its history. The amount of debt that was taken on in the post-COVID era, the amount of debt that was taken on by corporations, by consumers, and of course by governments is absolutely astonishing. And so to begin raising interest rates in this environment is not just a normal walk in the park. This is going to be extremely challenging for the Fed, and they may not be able to raise as high as they want to go, and they may not be able to do it as quickly as they want to do it. So when the Fed says something, it's telegraphing to kind of put its finger in the wind to see what the investors, are going to say. Kind of dip the toe in the water, maybe is a better illustration, to see what's going on. And right now, when the Fed says we're planning on 3 rate hikes and we're going to make money less easy, we're beginning to see the stock market, really begin to sell off. The indices are still pretty high, but if you look at some of the internals, like in the NASDAQ Composite Index, for example, I mean, there is some major carnage in tech stocks and growth stocks, and a lot of this has to do with fears of what the Fed is going to do. The Fed hasn't done anything yet. I mean, it has accelerated its taper this year, but it hasn't completed its taper, and it hasn't begun raising rates. So it's all talk at this point, and therefore, I just don't know how much I believe the Fed is going to raise interest rates that aggressively, knowing how interest rate sensitive the entire economy is. They know more about that than I do.
So it seems like what you're saying is that the Fed is they don't have any way to ease any more than they already are. So they're looking to raise interest rates and stop tapering. So if the time comes where they need to save the markets, they have that ability to do so. We hear a lot of people talking about the stock market being extremely overvalued, but it keeps being propped up by the Fed. So your perspective on that, will we ever see a crash for the stock market? Or is this the new normal of just the Fed easing in the stock market continuing to be at all-time highs?
Stock market's always too high. There's very few times when people look at the stock market and say, boy, this is a discount, right? Very rarely. I mean, maybe parts of the economy, maybe certain sectors. But normally, under normal circumstances, every year the stock market is too high, according to analysts. Go back to 1986. There were people who were talking about how high the stock market was. You go back to 1993, and you hear about how high these stocks were. In 2011, the stock market was overvalued. In 1972, the stock market was overvalued. So in other words, we live in a perpetual overvalued situation. That's just kind of where it is. So we have to kind of be used to that. There is an idea that somehow because the government is bankrupt, somehow that means that Apple has to crash and go to zero. Well, it would be an incorrect statement. Apple could outlast the American government. ExxonMobil could outlast the United States government. In fact, they probably will. Chevron could probably outlast, they operate in 190 countries, so there's many corporations out there that I believe will actually outlast the United States. And so I'm not as concerned about well-run corporations that may have excellent revenues, diversified across the globe. Think of something like Coca-Cola, or think about something like Apple. Think about something like Pepsi, Cola. These are all, Pepsi's at a new all-time high this year. Coke's at a new all-time high this year. Consumer staples have been hot because people have been, looking for quality stocks, value stocks in this environment. But I'm not as concerned about, high quality stocks in this environment as I am about, what happens to our money, what happens to our currency. We're living in a time of great inflation that causes the price of all assets to rise over time. And I simply think that if you're going to be in the stock market, you should be in quality stocks, right? Forget growth, forget value, think high quality. It's the same thing if you're going to be in mining stocks. A lot of people want to gamble on, stocks that don't have any income or anything, and they're gambling on hope. If you're going to be invested in mining stocks, be invested in quality mining stocks. They're out there. So I would say, if you're going to be in the market, be looking at quality here. There's going to be a lot of great opportunities going forward, but quality is where it's at if you don't want to get hurt over the long term. Now, if you're a trader, if you're like, I'm going to buy a stock and I'm going to be out in 6 weeks, you're probably going to lose money. Who knows? But if you have a 10-year time horizon, 15-year time horizon, focus on high quality companies that make money and that keep part of it every single month. That's known as net profit or earnings, and make sure the companies you're investing in can weather these kinds of storms.